Hello everyone, and welcome back to Explain the Charts. Today is October 10th, 2025, and we are doing an in-depth analysis of the S&P 500 ETF, ticker symbol SPY. The market has been on an absolute tear, hitting new all-time highs, but the last couple of days have shown some weakness, so we need to break it all down. First, we'll cover the major news events driving the sentiment, and then we'll dive deep into the charts to see what the price action is telling us. The big headlines are dominated by a few key themes. First, minutes from the Federal Reserve's September meeting suggest that more interest rate cuts are likely for the rest of 2025, which is generally fuel for the stock market bulls. However, this optimism is being tempered by an ongoing U.S. government shutdown, now in its second week, which is delaying crucial economic data and creating uncertainty. We're also hearing a lot of chatter about a potential AI bubble, with some strategists warning that profit-taking risks are high, especially in the tech-heavy Nasdaq. At the same time, assets like gold have surged to over $4,000 an ounce, in what some are calling a debasement trade, as investors hedge against inflation and government spending. This suggests there's a significant amount of anxiety simmering just below the surface of these record-high stock prices. Now, looking at our daily chart for SPY, you can see this narrative playing out visually. The long-term trend is undeniably bullish, especially since the dramatic sell-off we experienced back in early April. The market bottomed out around the 481 level on April 7th and has since rallied an incredible 35%, perfectly aligning with the news reports of a torrid rally. This massive uptrend has been fueled by the very things we just discussed: optimism around the AI boom and the anticipation of Fed rate cuts. We recently broke through the previous all-time highs set back in late August around the 649 level, which was a significant psychological barrier. The price then pushed all the way up to a new record high of 673.94 just yesterday, on October 9th. However, yesterday's candle shows a retreat from that high, closing lower at 671.16, which suggests some selling pressure is stepping in at these elevated levels. This could be the beginning of the 5 to 7% pullback that some analysts in the news were predicting before a potential year-end rally. The primary long-term support to watch is that major April low around 481, but in the more immediate term, the swing low from early September around 635 is a more relevant level. Any significant downturn would need to break below 635 to challenge the primary bullish trend. Let's zoom in on the daily chart to get a clearer picture of the more recent action since the start of September. Here we can clearly see the dip down to the 635 level on September 2nd, which now serves as that key medium-term support. From there, the market ground its way back up, consolidating for about a week in late September between roughly 661 and 667. The breakout above 668 at the very end of September was the technical signal that kicked off this most recent leg up to the all-time highs. That 668 level now becomes a critical support level to watch. A drop below 668 would indicate that this current pullback has more room to fall and could signal a test of the lower 660s. Now, let's switch to the 1-hour chart to analyze the texture of this recent price action. Looking at the last few weeks, we can see the market has been climbing, but with periods of sharp pullbacks, indicating some indecision. The ascent from the 660s in late September to the recent 673 high wasn't a straight line. It was a choppy climb. This reflects the push and pull of the news cycle, with bullish Fed news competing against bearish shutdown and bubble concerns. In the most recent trading sessions, we see a clear topping pattern forming around that 673 level. The price made a high, pulled back, and failed to make a significant new high before selling off. This short-term weakness is what we need to monitor closely. Drilling down to the 15-minute chart gives us an even more granular view of the past few days. We can see the market gapped up on October 8th and trended higher for most of the day. The buying momentum continued into October 9th, where we see the ultimate peak at 673.94. But look at what happened immediately after that peak: a sharp rejection and a steady downtrend for the rest of the day. The price sliced through several intraday support levels, eventually finding some footing around the 670 mark before a weak bounce into the close. This price action shows that sellers are currently in control on the shorter time frames. The key battleground for today's trading will likely be between the resistance at the 672 level and that support around 670. A break below 670 would open the door for a test of that critical 668 breakout level we identified on the daily chart. Let's pull back to the daily chart one more time to put everything into perspective. So, what's the verdict? Are we bullish or bearish? The long-term trend remains strongly bullish, and pullbacks are a normal and healthy part of any uptrend. The bullish case is that this is simply a pause to refresh before the rally continues, driven by the prospect of lower interest rates and continued strength in AI and technology sectors. For the bulls to remain in control, we need to see price hold above the key 668 support level. The bearish case, however, argues that the market is overextended, valuations are stretched, and the underlying anxiety shown by the surge in gold is a major warning sign. The government shutdown and fears of an AI bubble could be the catalysts that trigger a more significant correction. A decisive break below 668 and then 660 would give the bears significant momentum. Let's recap the important price levels to watch. Immediate resistance is the all-time high zone of 673.50 to 674. A sustained move above 674 would be extremely bullish and could target 680. Immediate support is the 670 level, followed by the more critical support at the 668 breakout point. Below that, we have the consolidation zone around 660 and major medium-term support at 635. My primary expectation, with about a 60% probability, is for some choppy consolidation between 668 and 674 as the market digests these gains. A sustained break above 674 would reinforce the bullish case. I'd assign a 30% chance to a deeper pullback, where we break 668 and test the 660 level, which would become more likely if negative headlines about the shutdown's economic impact emerge. A direct continuation of the rally from here without any consolidation seems the least likely, at around 10%. Looking ahead, the big thing to watch for next week is the start of quarterly earnings season, with major banks set to report. With the lack of official economic data due to the shutdown, these earnings reports will be under a microscope for clues about the health of the economy. And that's our breakdown of SPY. Please remember, this video is for informational purposes only and is not financial advice. You should always conduct your own research and due diligence before making any investment decisions. Thanks for watching Explain the Charts, and we'll see you next time.